Kamau says, I'm currently in a double diagonal, 523 to 616, 580 foot. Spread cost was 964, and I'm currently up 13%. So using this example of what I'm doing, any thoughts and issues with this trading style? We're just going to look at a double diagonal. So we're taking a look at a calendar spread. Kamau is in a horizontal spread with different expirations and the same strike prices. But it sort of creates a similar Iron Condor profit and loss chart, but with curves in it. How would I look at a double diagonal right now? I had mentioned Apple earlier. Let's just stay with it. Now you're about 15 points off from each of yours. Okay, that's fine. And you said the spread cost was 964 and you're at 523. All right. So we're going to sell an out of the money put. I'm going to take the 205 for this example for Apple. And it's 211, so we're 6 points down. And I'm going to stay at the that's 89 cents. I'm going to stay at the 217.50 call since we're in a bullish mode. We've been moving up. Maybe we're going to have some hesitation. I'm going to get a little bit more breath, not too much. Going 2 strikes, both of them are about 3 strikes out of the money. For the 23rd expiration, which is 7 days away. Now you added 613. Okay, so we're going to go to June 13th. And I'm going to buy. Oh, I took the wrong strikes, didn't I? I'm sorry, folks. No, 205, 217.50. I'm going to change this to the 215. You'll see why in a moment. I'm sorry for the scrolling. Let me clear this up here. So we're going to take out the 217.50 call and I only need 215. All right, so now we're going to go to June 13th finally. We're going to buy the further out 205 put, and we're going to buy the 215 further call. What am I doing here? I'm selling a 205 May 23rd put and buying a 205 put. Horizontal, same strike, diagonal spread. We're going to sell the near-term 215 call, and we're going to buy the June 13th call. We're going to use the midpoint prices. Now, this is a double diagonal, okay? Max profit shown. Okay, so what are we looking at here? Like I said, it's similar to an Iron Condor approach in this case, which is a neutral strategy. I don't want the stock to move too much. What I might have done in an Iron Condor, instead of buying the June, well, I would have bought it further out of the money. I would have sold the same May 215 call and sold the May 205 put. Then I would have bought a May 202.50 put and a May 220 call. So we'd have this straight line profit and loss chart with known risk on the outside wing instead of a short strangle, but it's a neutral position. If I feel I'm in a neutral market, there we go. If I feel I'm in a neutral market, I'd be more akin to doing the iron. Sorry, folks. Let me draw that better. Take a break here. I'd be more akin to be doing the Iron Condor in the shorter term. Why? Because in this range, if I'm neutral, I have a set profit if the stock stays below the short call or above the short put. I have a known risk on the outside wings. I'm not going to say a low risk. It's a known risk. If you overtrade it, it's beyond a low risk. Okay, you're taking on too much risk. It's a leverage position. The trick with the double diagonals is you see here, I have a max potential return of $130, $131 off of a risk, the debit of only $567. That's a 23% potential return. I am risking 100% of what I invest, but I'm only investing $567 per one contract. All right. Kamau says he's at a 13% profit. The spread costs $19.64 and he's a 13% profit. What you want to consider here is in this case, 131 roughly is a 23% profit, which occurs when? If and only if the stock is trading at this peak on May expiration, next week, 5/23. Okay, the weekly expiration. In the middle here, right at the 210, or right where we are right now, the max profit at expiration of 5/23 is only $45. It's about a third of what you'd expect of the maximum return. And down here, the same thing. If it falls a little bit to 208, I'm still only there. And if it hits the peak here at 205, I'm at a profit of 81. A little bit more than 50% of the max of 23. So I'm about 10%, 9.8%. This is why these calendar spreads are so difficult. Another reason that comes into play, Kamau, with these particular positions, diagonal spreads, calendar call spreads by themselves, calendar put spreads, double diagonals. You're using horizontals. I actually prefer to use the double diagonal as opposed to a true double calendar. This is a true double calendar because it looks like you're at the same strike price based on what you wrote on your discussion. Okay. What's the difference? Well, here I would have sold a 205 put and maybe bought a 200. Lower cost, but I have a different breadth of profit on the position. It's preference, really, Kamau. That's all it really is. All right, so related to that, depending on when you entered this position, what are the two things, or really 3 or 4 things, to me personally, in my calendar call spreads or my calendar put spreads? I don't do a lot of double diagonals, but when I do the diagonal, not the horizontal at the same strike. Any calendar spread, when you're selling short term and you're buying long term, this is just a straight calendar call spread. It would look something like that. Some people call it the poor man's covered call. I don't use that term. But that's the profit and loss chart. Here's my buy strike in the money on the call side. Here's my sell strike at or just out of the money. Now, what I typically want to look for in this position is, number one, an IV ratio of greater than 1, meaning the IV of my sell option is greater than the IV of my buy option. You should have had that when you opened this position. Based on what's happened in the last few days, when VIX spiked, the shorter term options had a higher implied volatility than the long option. But you want to make sure that that is positive. That is a filter you can use on calendar calls and calendar puts to make sure the IV ratio is greater than 1. Number 2, it's reversing that thought. This is sell over buy. And that's why I want it greater than 1. The delta ratio. In a sense, this is reverse. This is the buy option delta divided by the sell option delta. And in this case, when I'm buying a farther out option, mine is usually in the money, as I mentioned, and I'm selling at or out of the money. But I want that delta ratio for this calendar spread. I want this to be at least 0.60 or greater. You'll see that on the default searches in the straight calendar call or calendar put. Okay. Now, that just means that if the stock moves up, because I entered a bullish directional calendar spread, Kamau, that the delta of my long is gaining more than the delta of the short. When I drew this profit and loss chart, peak here, just like you see with this particular double diagonal, similar to Kamau's discussion, why does it fall off here? Because at this moment at expiration, this is my sold call strike, remember, this is our 215. At the sold strike, as it's increasing here, it goes above this sold strike. This option delta that I sold, the shorter term expiration, is going to 1. The delta of my farther out option is not there yet. It might only be at 0.8, gone up from 0.8 when I entered the position to 0.85 or 0.9. So I'm losing more on the short call if I have to buy it back, roll it. It's going straight to intrinsic, even though this one was deeper in the money, in Kamau's case, it's the same strike. But because it's farther out in time, it's not going to a delta of 1 just yet. It's at 0.8, 0.9. It's not there. That delta ratio that I use to enter the position flips when I get 1 or 2 days to expiration, because this option is either going to 0, which is beneficial, as you can see, it's a neutral strategy, or it's going to 1 if it's in the money, and I'm losing more on the short option. Over here, I'd be losing more on the short put if it fell below it. then I'm gaining on the long wing, even though it's the same strike and further out in time. Mine are usually in the money, but I see the same thing. That's the flip of the delta ratio. So that's what's important, I think, when entering these calendar spreads. Now, we're entered into this position. You said you've got a profit right now of 13% on the trade. What would you do? Okay, this comes down to your trading plan, not mine. Analysis. What was the best expectation I could have for this double horizontal, double calendar that we've entered for Apple right now? The best case scenario, theoretically, mind you, this is based on the theoretical values of the stocks trading at these prices at expiration. That can change if the VIX and volatility continues to decline as it has been over the last 15 to 20 days. Okay, so this profit might be less. But let's say this was my peak profit, and down here, my peak profit was a little bit lower. Let's say it was I'm at 130 here. We're at about 90 here, so that might only be 12 or 15%. Down here is maybe 9 or 10%. So now you're talking about your own personal trading plan, which I can't give you guidance to directly. What I mean by that is you're using double diagonals. You're using this strategy in your portfolio because you feel that this structure in this market matches your expectations for the market trading and matches your goals for risk and return. Okay, that's great. I love it. I like seeing these double diagonals. They're fun to play with. I set it up differently than you do. Hey, to each his own, or to each their own, him or her. Now, max profit I know is 23% in this situation. I've been in the trade for 10 days. The stock moves up to here. My max profit is 130. So I've been in this trade, for 3 or 4 days next week. Apple moves up to 213. Let's call it right here. And I could liquidate this position right now for about $75, $80. A little bit more than 50% of the max return that I expected on the trade. So now the question is, now the stock has moved, what are your expectations? Do we feel this is going to continue for the next 4 or 5 days and get to my peak closer to this 23% return? Or do I think this is a good time to close the position? Have I made at least 50, 55, 70% of 60% of what I expected to make on the trade? And I think now is a good time to close it down and readjust the calendar to the next cycle. Instead of now, I could keep the Junes open, right? I could keep these June 13s open, but maybe I roll now from the May 23rds to the May 30th. But I re-bracket the trade a little bit. Now the stock's at 213. Maybe I'm at the 220 sold call, and maybe the 207.50, 209. I'm moving this up from 205, getting that premium in the range out of the money that you wanted to when rolling that trade. Okay? This comes down to your goals and your expectations and your risk-reward tolerance. I'm going to break real quick here and just talk about bull put credit spreads. We're not going to show a bull put credit spread coming up, but I'm going to talk about it real briefly. In what aspect? When I enter a bull put credit spread, I'm typically following the weekly bull put default search and power options. I'm looking at around something with a 12%, 13, 14%, maybe 15% return for 11 to 14 days out on time. When I open new positions on Monday, it'll be 11 days out in time. Okay? I want an 85% probability. Now, I get a lot of comments on YouTube. I get a lot of phone calls. I get a lot of discussions here when people call and say, hey, you're setting up a deep out of the money bull put credit spread that, yes, I get it, has an 85% profit. But if you're looking to make 12%, 15% on a $10 spread, you're looking to make $1.50. You've got an 8-to-1, 9-to-1 risk-reward ratio. You'll never make money. You're right. If I took the full loss on every bull put credit spread that I had, was right 85, actually it's about 87% of the time. I was right 87% of the time and made 12 or 15% when I was right, I wouldn't make money. This is where management comes in. This is where trading plan comes in. I never take a loss of more than 50% on my bull put credit spreads if the stock starts to move against me. Still right 87% of the time. I only lose 4 or 5 points at most on these positions, still making the $1.50 in this example. So I'm making a little bit more, you might consider 30%. That's not true. My risk is still the 12%. I'm still risking 8 to 1 or 7 to 1. You don't allow it to hit that. You have a trading plan in mind. Why am I going through that example for you, Kamau? Because this is what you're asking me. You say, should I take my 13% return? Number one, I can't give you that direct advice. I'm not a financial advisor. I don't know what your original risk and exposure was on this trade. You mentioned some of it there. But what you've got to consider now is a trading plan. My best expectation is here, which might only happen 0.2 or 0.3% of the time on these trades that I open. Down here, what did we say, about 11 or 12%, about half, little, not quite half, but near that. Actually, yeah, it was really near that range, but let's call it 12% if the stock's trading here. Well, it's only going to hit there 0.1, 0.2, 0.3% of the time over time. You're in this profit zone here, this little happy smile. Yes, I just made a frog face. I understand that. Little froggy face. But how often, let me backstep that. How often for you, what is your success rate on these double diagonals over time since you've been trading them? You're only going to see these maximum peaks, 1%, 0.5% of the time. So you got to be in this range. Froggy face again, sorry. How many times are you down here? How many times have things just moved against you? What you need to set up is a trading plan. If I close my positions here, I'm not getting 23. What if I close them at 10%? Am I increasing my success rate of return instead of waiting for it to get up to 15, 12, 17, 20%? But you're still going to take these losses. These ones that go against you are still going to go against you. Can you really increase your success rate by doing that? Number two, I didn't really number these well, but the second concept is, if that's not profitable for me, what I'm doing there, if I'm taking this 5, 7, 10% early, but occasionally I still have a swing against me where I'm losing in these ranges, is that profitable or not profitable with the success rate? So I'm closing some positions early that may have had a higher profit, but didn't end the loss. But a lot of times once you enter them, they go to the loss right away anyway. So now what is your profit in those ranges? If I take this at X% profit with still taking these amount of losses, am I profitable long term? Do I need to go to 10? Do I need to go to 12%? Do I need to close them at 13? Will I take 1 or 2 of these losses out of the picture on my percentage? Okay, that's what you need to look for. That's the trading plan you need to develop. Is 13% the return you have right now half of the maximum that you expect on this position? Possibly. I'm sorry, if it is, you might want to consider that. But you're going to need to do some analysis on this trade, this trading structure in your portfolio, Kamau. And you should, all of you should be doing this in any structure, whether you're just starting out with covered calls, whether you're trading credit spreads, as I just mentioned how I approach them, whether you're trading Iron Condors. Hey, is there a point where I should take the profit off of the top? Should it be 50%, 60%, 70% of the expected profit, the max profit on the position? Should I get out then? Does that help increase my success rate if I close some of these positions out earlier? Maybe, maybe not. In my experience, by the way, with bull put credit spreads, the weekly bull puts that I use, the picks of the day, that's my preferred trade in the right market conditions. I am going to possibly look for new positions on Monday. But in any case, I don't do that. I know they teach, there's other places out there that teach that, hey, I'm going to close a position when it hits 50% of profit. We're opening a debit spread that's 45, 50 days out, even a credit spread that's 45, 50 days out, and I'm going to close it when it's at 50% profit. We've actually done some webinars comparing them. I go shorter term and look for the full profit at expiration, and I close the positions following some discussions we have on our webinars on managing the bull put spreads. I don't let them go more than 50% loss of the maximum loss that could be realized in the bull put credit spread. And that's worked out better for me than trying to open positions 45, 50 days out in time and then closing them at a 50% profit. I'm also making extra work for myself in those situations. So I don't want to do that. And so this, Kamau, is something, you've got to sort of piece out for yourself. When you open these trades, what kind of returns are you initially expecting? What is your profit zone here? That's 80. Okay, let me back that off. 60% of the time, you're probably going to be in this range of profitability on these positions in the right market conditions, such as a melt-up market of 2021. What we've seen in the past, 2023, 2024, things of that nature. I'm sorry, 2020, naturally. But what we've seen here in 2025, what we saw in the Powell market of 2022, Iron Condors, double diagonals, even though volatility is high, was not the way to go because you're getting breached on these sides way too often. Melt-up market conditions, you're in here probably 70 to 80% of the time. You're probably in this zone. 5% of the time, you're probably here 5% of the time. And then the remaining time periods, you're down here because of wild, unexpected swings. So that kind of consideration. Yes, you can manage. Of course, there's management available all the time. But with that kind of consideration, if you establish yourself a ratio of, hey, I'm in this zone 50% of my trades, I'm here, I should use a different symbol, here and here, 12% of the time, I'm here and here 6% of the time, and I'm down here 5% of the time. Now, at what point can I increase performance? Is it by closing positions early, taking the smaller profit and accepting it? Do I need to take 50% of the maximum profit, which I'd only see 0.2, 0.3% of the time? And what do I need to do to avoid these, if at all possible, with my trading structure? All right. Work that out a little. Take a look at some of your past trades. Plan that out. Look at some historical prices. What have happened if I closed here and closed there? And then send me an email later on sometime when you've got some ideas on that, and we can walk further through it, okay? All right. Kenneth asked me a question here, but he says he answered it himself. So I might take a look at that a little bit later. He says, you could disregard my question. I figured it out. Okay, Kenneth, I probably will. We've got one more follow-up for Kamau real quick here. We're just going to take a look at it. It's related to the radioactive trading techniques that Mary puts. Let's change complete gears here. Going off of the diagonal spreads, useful positions. I like the diagonal spreads. Different ways to play them using weeklies and 1 month, 2 month out in times, things of that nature. Different structures you can use. But again, what are we looking at in general here? It's a neutral to bullish position. I'm sorry, it's a neutral position, just like an Iron Condor, just like a short straddle, just like an Iron Butterfly. You want to make sure you have the right market conditions for using this structure. And if you're going to use this structure long-term in your portfolio, you want to start to develop an actual trading plan instead of, and there's nothing wrong with your question, Kamau. It's, hey, 13%, I could take it now. Should I take it? If you've only got 7 days to go to expiration, I mean, like I said, I can't give direct advice, but hey, 13, I don't know how long you've been in the trade, of course, but hey, 13%, if you've been in it for 5 days, you've got a 13% return. That's a win. I'm not going to deny that. That's just mathematics, of course. But what is your trading plan? Why are you using this strategy in portfolio? What are your return goals for this strategy in your portfolio? And if you start closing positions out at 10 or 13%, hey, that's fantastic. But if you're expecting 15 to 20 and you're closing out at 10 or 13, how does that affect your long-term plans for this strategy? How does that affect the profit you're expecting in this strategy? And are you actually increasing your success rate by closing early, or the ones that are going against you still going against you in the shorter term because of an unexpected event before you hit that 8, 9, 10%, 13% profit, where you haven't really increased your success rate, you've just lowered your potential return?